All right, Friday, March 29th, TGIF. So, what do we got? Stock market moving higher. Folks, we are on track to make new record highs and then some. There is a tremendous amount of fiscal support. I've been talking about this for a long time, and you want to know what's interesting or funny? I mean, I've been talking about this and telling you this now for the entire fiscal year, and by the way, the fiscal support was already enormous last year. This year it is like mega above what it was last year. This is finally starting to hit the mainstream news. Now, I've been telling you this now, for the entire fiscal year. All right, what are we talking about? We're talking about 5 months. I've been telling you, 6 months, I've been telling you that the fiscal picture is extremely strong. That's government spending. Now, headline on top of Drudge Report, federal spending hits the highest level ever. So they're just starting to catch on now, but this was, and I explained this, I've explained this so many times, this is the tide that floats all the boats. This lifts everything up, and not only the fiscal part, but I've been telling you about bank credit. Bank credit has not only been expanding in most metrics at new all-time highs, at record all-time highs, but the rate of growth in bank credit, loans and leases, etc., has been accelerating now, and that has been happening since November, and that's why I told you the stock market correction in November, December was just that, a correction. And recently I've been telling you that the metrics since January, early February, have been starting to accelerate, and that would negate the recession hysteria that we have been hearing. Which means, number one, the Fed panicked. Jerome Powell panicked back in late 2018 because of the stock market correction. He is terrible. Folks, I have gone on record to say he is the worst Fed chairman that I have seen in my whole entire career. And that goes all the way back to 1979. So I was there with Volcker, and then I was there with Greenspan, and then I was there with Bernanke, and then I was there with Yellen, and now I'm here with Powell. This guy is the worst. He has ceded the monopoly price-setting power of the Fed over to the bond market, to players in the bond market, to Wall Street, who themselves have no clue about what they're doing, or no clue about the real functioning and understanding of the monetary system and the economy. All right, so he's just basically said, here, you decide. That is terrible leadership, number one. So the Fed panicked. By the way, we saw recently that the Atlanta Fed, who puts out this metric called GDP Now, it's a forecast for GDP looking forward, for the last basically 2 months, they have had first quarter GDP at below 1%. As a matter of fact, it was as low, their forecast was as low as 0.24% that's annualized for first quarter GDP. They just bumped it up to 1.54%. Now that, I agree, that's not a booming economy, but that is a big upward revision from 0.24%. Who has been telling you this? Right here. Oil prices now well above $60, although we had a pullback this morning, but we're headed higher. Trump attempted again, I think this is the second or third time, he attempted to tweet the market lower. The market ignored him. Why? I explained. The Saudis said, hey, you stabbed us in the back once, you're not going to stab us in the back twice. Fool me once, shame on you. Fool me twice, shame on me. The Saudis are not falling for it. Trump tweeted what happened. There was a pullback. I said to all my subscribers, buy that pullback. We ran up now over $60 a barrel and on its way higher. Okay? So, bond market. As I said, Powell overreacted. He panicked. The whole entire Fed panicked. They're talking about no rate hikes this year, maybe no rate hikes next year. The bond market is already pricing in rate cuts. By the way, inflation is picking up. Oil prices are very fundamental to the inflation outlook. You have now gasoline prices in some parts of the country above $4 a gallon for gas. That is going to start to show up in the inflation statistics. So all of this hysteria or concern about, the economy slowing down, that is wrong. No inflation, that's going to end up to be wrong as well. Gold pulled back, I said 2 weeks ago, or maybe it was a week ago. Took profits on gold. We bought back on the dip. We bought back on the dip, back into a bullish posture on gold. What else? We had once again a no on the Brexit vote today. You had a short sell-off in the British pound. We'll have to see what happens there, but I contend that Britain leaving the EU, or even if it stays in the EU, is not a negative for the British pound. And I have in the past talked about, before the EU even existed, before there was a Eurozone, before there was a euro, and all these countries traded in accordance with WTO rules, the pound was much higher. So to go back to that framework does not in any way suggest a weaker pound, particularly when the UK is running under an austerity type of a program. So we'll see how that plays out, but I would not be surprised to see, when there's a no Brexit or a final divorce from the Eurozone, that this is all already discounted into the British pound. So, to sum up, there has been nobody other than myself out there laying out this outlook as it is now coming to fruition. Everybody hysterical about recession. Everybody hysterical about the inverted yield curve, which I also said was something which people were paying way too much attention to. And it was based on technical factors such as the debt ceiling, which, by the way, is still in effect. So there is going to be resistance to higher bond yields. However, the bond market will respond to improving economic conditions. And the Fed will as well, maybe not right away, but be patient. And eventually you'll start to see some Fed members talk about, hey, you know something? Maybe the economy is picking up steam. They'll start to give hints that maybe we went through a soft patch and things are starting to pick up. Once the bond market gets a hint of that, gets a hint of perhaps even the most subtle shift of the Fed's perceptions of what's going on, you see a big reversal higher in bond yields. So again, to sum up, I've been the one saying, look, I focus on the data. My data is forward-looking. It is actually the stuff which create the conditions in the economy. These are not data that reflect what already has happened in the economy. They create the conditions that drive the economy. Nobody else looks at this. I am the only one. So, I'm the only one with an applied approach to MMT. I have been right all along. I will continue to be right because we look at the right things with the right understanding, and that is key. And we have patience to allow these things to work to their logical conclusion. So let's follow what's going on. So far everything is moving along in the direction that I said. And I'm pretty confident that we'll end up where I said we're going to end up. Have a great day. Bye-bye.